Okay, we're going to get started by looking at the S&P 500 like we usually do. We see that we are at a huge decision point in the stock market right now. First of all, we have recovered a lot of what we lost at the beginning of April, and we are right at the 200-day moving average. The green line right here is the 200-day moving average. Um, And it's extremely important for the stock market to continue to trade above that 200-day moving average. Um, we have a very interesting article that came out made by Josh Brown. He mentioned that this is how tops are formed. Now you can see that we made a top right here in middle of February, and we tried to go over that top right here, but we failed and we went back down. So we're at a very crucial um, time in the market. So if we don't hold at the 200-day moving average, the next spot is right here in our chart going up. We have this little mini upward trajectory. Last week we were at the top of the range, and all the stochastics were overbought. So I mentioned that we could be going down towards the bottom of the range, which is right here. Now, keep in mind that we're in a bear market right now, it seems. We have, if you trace the downtrend right here, we have lower highs and lower lows. And let's hope that we hold above the 200-day moving average and break out of this. And then we'd be in a sideways, we're kind of in a sideways market. But we've had some major bad news this week. We had a downgrade. Let's look at Josh Brown's summary of what happened this week. This week, Moody's cut their rating for the U.S. Treasury on the heels of the Trump tax cut bill being rammed through the House. There weren't They weren't thrilled with all implications for the budget deficit. In bond land, the yield on the 10-year Treasury shot up over 20 basis points, while the yield on the 30-year has done something that it hasn't done in 17 years, breaking above the 5% and staying there. Stocks got wobbly. Then Trump iced the cake with a barrage of tweets threatening Apple about making iPhones overseas, vowing retribution against Walmart for raising prices, and telling the EU um, that they're going to impose a 50% tariff if they don't uh, do something by June 1st. So this pretty bad negative sentiment. The great, the interesting thing about this is it adds an amazing amount of uncertainty to the stock market. And whenever the stock market is in a downtrend and news like this comes out, um, the trajectory will probably continue to go down. Um, Now, the one thing that we have going for us this week is we have earnings from NVIDIA coming out. So NVIDIA's earnings come out. mm, NVIDIA comes out Wednesday. So, whether that could take the market up or down. Now, NVIDIA has been ramping up into this earnings print. So there's something called buy in the rumor, sell on the news. So NVIDIA has, it's gone up at least 30% in the last month. So um, even if it meets and exceeds estimates and it gives great estimates going forward, their stock could still go down 10%. So the numbers say that they'll go up or down 7% after earnings. So even if it does go down 7%, it's a buy the rumor and sell the news. But if they miss the earnings just a little bit, um, their stock will go down like an amazing amount of way. So this seems like right now we're in a wait and see mode with this, where we're going to go. Um, so we'll just watch for what happens next there. Okay, now let's look at our some of our talking points. Where are we are in May. We are currently in a holiday. A lot of times people come out of the holiday refreshed and in a positive mode. So, but we are overbought right now. Let's look at the stochastics of our S&P 500 right now. Okay, so you can see that we are overbought, and we've been overbought for at least a month. So, and we're starting to go down, and we're starting to, the market's starting to get a little bit weak. We've had the stock market go down more this week since the beginning of April when we had a crash. So, so we started to go down in stochastics, and we're in a trajectory down, but we are super overbought. We are above the 200-day moving average and the 150-day moving average, which is very positive. And if we don't stay above that, we're going to go um, hit this level in our uptrend channel lines. And you can see that I drew this downtrend. This is what Josh Brown says that this is how tops are formed. We fail to break out and go past this prior high, and we have a lower low. So it looks like we very, very well could be in a bear market where we go uh, lower highs, lower lows. We don't know until later this week what happens if we continue to go in this uptrend or to go in the downtrend. All right. Um, okay, this is an article sent out by Josh Brown. His business is called The Compound. He says, this is how tops form. It's not too late to pull out of all this. But, okay, so he mentions that he thinks that the S&P, the Dow Jones, and NASDAQ are in the process of putting in a short-term top that could be something more ominous as we head towards the second half of the year. Now let's look at the here it is. Average stock month market returns. Look at June. We're going into the worst months of the year for the stock market. We have June, August, September as super bad months. So the odds are not in our favor for June to go up. We are already overbought. So there's a good indication that we might be um, gearing up for a bad June. We don't know. We're overbought right now. July has traditionally been a better month because we have the 4th of July and because mm, people are out having fun during that time on vacations. All right. So now let's look at some more things we can talk about here. After NVIDIA earnings at the this Wednesday, we don't have earnings for another couple months, basically. Um, we have usually July has been a good month, and then we have October is usually a good month. We have good months in December and November usually. However, right now there's a dynamic where a lot of the people in the stock market, like let's say Walmart, a lot of companies tried to buy things ahead of tariffs. We had January, February, we knew right in the beginning of April that there was tariffs coming. So companies ordered much more than they wanted. There's people that bought iPhones because they thought they would have tariffs on their iPhones. So a lot of people, um, it's called they bought way more during the first quarter of this year and the second quarter And that basically means the later quarters, such as July, August, September, October, November, are not going to be as good. So there's going to be a lot of disappointments in the October earnings because let's say NVIDIA isn't going to sell as many of their chips because people pre-ordered them for the first quarter. So this is what Dan Niles is saying, and he's been right on target so far this year. So we have that to think about. So all right, so let's continue with our talking points. One of the biggest news stories this week is the 10-year and the 2-year have shot up 2 and 4%. That is, and bonds are going up around the world. Let's look at the let's look at the 10-year and how it went up this week. Comparison to the S&P. Okay, so you can see the bond, the yield for the 10-year bond went up, is going up lots recently. The reason why that's concerning is we also have other yields for around the world going up. So Japan, their 30-year bond is higher than it's been for like 30 or 40 years. And the reason why that's important is there's a lot of people that used to invest in the United States, such as in the big tech stocks in the United States. And now that the local currency, the local bonds are yielding more, they might they might not take the risk of investing overseas and invest in their own bonds. So whenever you have the yields of bonds around the world going up, that's an alternative to stocks. For instance, if you have yields around the world that are paying maybe 9 or 10%, and bonds are a lot more secure and sure than stocks. So if the yield around the world and even in the United States goes up, like our 30-year bond is yielding 5%, a lot of people won't take the risk of buying stocks and they will buy bonds instead. So you have that as a headwind, a problem for stocks. On top of that, we have a president that could be um, announcing a tariff on another country out of his whim. That will lead to an edgy stock market, and people will not pay as much for U.S. stocks. So it looks like the certainty we've had for the last 5 years has gone away, and we're back in we're back in a state of waiting for a tweet for our investing decisions, which isn't very secure. Okay, so last week we had 77% of the S&P above the 50-day moving average. It went down to 59 after the stock market went down some. Same thing with the 200 days. So we're losing momentum, and we have a lot of uncertainty, especially around um, tariffs, comments, and geopolitical issues. Um, some of the more secure investments that are holding their value and going up recently have been United States plays, stocks that stocks that do business with the United States and don't have a whole lot of tariff issues. Stocks that fall within that realm are telecom stocks, financial stocks, utilities, and consumer staples. So those are going to be the stocks that are steadiest for the rest of this year, it seems. Okay, so um, let's look at the 20-year on the S&P. That's 5-year chart for the S&P. You can see the April lows um, fell within the range of this 5-year um, channel. There's something that in the stock market where we retest lows. And if we, there's a very good possibility, is a possibility, it's not zero, but there is a possibility that we might retest this low we had in April. That's going to be very scary, but it's something that's happened a lot. And if we hold at that spot, this low that we've had, then that's a very strong indication that we can continue to go upwards. But we don't know if we could be making this new lower lows and lower highs. So that's all something we're going to find out very soon. Okay. The other thing we have to remember is there are market participants that are borrowing foreign money, such as from Japan, and investing in United States companies. And that's called the carry trade. And there's a very good chance that if this Japan 30-year bond continues to go up in yield, people will be forced to sell the Mag 7 stocks and a lot of these stocks that have been um, holding up the market in the United States. The reason why I mentioned that is that there is artificial selling like that. We have to realize it's only going down because of liquidity purposes. So if we see Microsoft go down 50%, or if we see some of the tech stocks go down a lot, then it could be because of this unwind of the carry trade. So it's something you got to keep in back of your mind. If it happens, you got to be ready to start buying. Um, but it seems like all of the pieces of the puzzle are coming together to um, force the market participants that have done this carry trade to unwind their positions. So if we have a big sell-off in the stock market where we go back and retest these lows, or worse, um, we got to watch the top holdings of our we got to watch the top holdings of our mutual funds and be ready to start dollar costing into those. So let's look at some of the top holdings of the mutual funds, just because we do that every now and then. Here they are, right here. Okay, so Fidelity Contrafund, one of the best mutual funds out there, it has 17% of their money in Meta. Then Berkshire Hathaway, Nvidia, Amazon, Microsoft, Apple, Eli Lilly, Netflix, and Google. Okay, during a market sell-off, all of these stocks are going to be going down, usually proportionally. I mean, all of them will go down together. So the important thing is a lot of times, whenever the market goes down, people sell the S&P 500. And a lot of times the biggest tech stocks are part of that. So they will go down. And you have to understand sometimes stocks go down not necessarily because of their prospects, but because of just the whole market goes down, so they go down with it. So we'll keep our eyes on these top holdings of the major mutual funds. This is the time of the year when um, 13Fs are filed. 13Fs are whenever companies, mutual fund holders, hedge funds tell you what their top holdings are. We'll go over some of that today with Bill Ackman when he just gave his top holdings. Okay, so let's look at some more of our talking points. Okay, so the 10-year going up is, and the 20-year and 30-year going up is very important because the United States is in a position where they have to refinance a lot of their debt with selling treasuries. And the higher this goes, the harder it is for them to refinance that debt. And also, the stock market, it gives an alternative to the stock market. So if the US Treasury yields 10%, and then who would want to buy stocks and take a risk in owning stocks? So you have an alternative to stocks. The higher this yield goes, the worse it is for the stock market. All right, so let's look at some of our variables in the stock market. The WTI crude is still at 61, hasn't changed since last week's. We have a lot of OPEC is actually starting to produce a lot of um, oil, so that's keeping the prices lower. Um, Usually, low price of oil at 61 is an indication that the economies around the world are slowing down, and our inflation rate went down just a little bit. It's 2.31. Last week it was 2.39. Um, so far, we haven't seen any pressures from tariffs yet, but that's going to be coming up in the upcoming readings. So the US dollar is down another percent. As you can see from this chart, we are definitely in a downtrend. The An important thing to realize is that the United States will never go bankrupt. We can always print money to cover our debt. However, if we get into situations where we're spending more and more and we get out of control with our spending, then the value of our dollar goes down. So who's going to want to invest? What foreign country would want to invest in a country where their investment's going to be losing value? And on top of that, we're investors. So if you have $100,000 in the stock market this year, at the end of this year, I mean, so far this year, we're down 10%. The dollar has lost 10% of its value. So our ability, our earnings, or no, our spending ability has gone down 10% if you had money in the bank. And that's pretty bad. So we're in a bad situation where the more debt that we issue, the more that we spend in the government, the more the dollar will go down. Now, one way to protect against this is to buy gold because one of our formulas is gold has gone, our formula is a stronger US dollar tends to drive gold prices lower, but a weaker US dollar drives gold prices and all commodity prices higher. So one way to protect against this is to buy gold. So I'm starting to think about that. Okay, let's look at the fear and greed index. People are greedy now. Our translation, take some profits off the table or don't buy. So so we've gone from extreme fear a month ago to greed now. People are buying the dips instead of selling the rips. So this is usually the indication that we're topping out in the stock market, like Josh was saying. So let's look. Oh, look at that. After 12 weeks of bearishness, it's gone. How far has it gone back here? January 29th was the last time we had a bullish reading on the AAII Invest and Sentiment Survey. So since February 5th, we've had bearish. All of a sudden, we have bullish. That is um, our translation is caution, take some profits off the table or don't buy. When the retail crowd is bullish, that or the amateur investor is bullish, that's usually an indication where it's time to stop buying. Okay, the VIX. you can see it is near a low, but we're starting to get more fearful in the market. We were at 17 last week, which is very low. People are not afraid. And we're at 22. So fear is beginning again. So where are we right now in the emotional graph? So, we had a period of time 1 month ago where we were at capitulation. People were afraid. And right now we're in a position where in a bull trap, it seems. We went down some and we recovered, and it seems like we have greed, a fear of missing out, and but we have a lot of negative, hugely negative news that come out. For instance, we have the president saying we're going to have 50% tariffs on one of our most important trading partners in Europe. Trump says we're going to have 25% tariffs on iPhones, and that would crush Apple's profits. Um, what the reason why these are so important, and we have a downgrade of the U.S. debt by Moody's. So you have the possibility of the president announcing tariffs randomly or capriciously, and that will get the market on edge. So, so we have a sense of, we're returning to the normal. So we're back to a normal before all that tariff started happening, but we're still in a downtrend. You can see we have lower highs, lower lows, and we're just one news story away from the stock market going down. Um, let's look at things that could lead to a crash, things that could be present now. The U.S. economy is slowing. It's not in a recession, but it's slowing down. We have a weak dollar, and that brings up the cost of commodities. So if the dollar is weak, if gas prices start going high, they're low right now, but if they start going high, that's going to cause inflation. That's going to increase inflation. We have tariff threats. Tariff threats. This is co companies. It's very hard for companies to plan and for their build out of making products. If you don't know if there's going to be tariffs on a country, how can you build a plant in America? How can you invest as like for instance, Apple has been diversifying away from China because there was threats, against the Chinese. There could have been sanctions against the Chinese. There could have been all kind of issues with the Chinese government. And so Apple invested in India as a way to diversify and Vietnam for their manufacturing. And now and now Trump is actually targeting Apple and saying, make it in America or you're going to get tariff. You're going to get a lot of tariffs. So there's going to be a slowdown in the economy and companies growing because how could you plan a build out of a factory without knowing if there's going to be tariffs tomorrow or if there's going to be 50% tariffs against India tomorrow or whatever. So this is causing uncertainty, and if people are going to pay less for the stocks in the stock market whenever there's uncertainty and fear. Um, but that's just something to think about. Okay, so we're still at a PE of 23.6, which is very high. We have yields, at 4.3 and 5% for the 30 year. So the last time, let's look at the 4%. Okay, the last time we had a 5% yield, last time we had a 5% yield, the PE was 16. So so the stock market, as the yields go up, people are willing, less market participants are less willing to pay a higher price for stocks. So we could very easily have a correction because of that rationale in general. Let's look at our worst at first. Our worst, our best performing stocks last year, communications sectors, IT, and consumer discretionary. The worst, materials, consumer staples, energy, healthcare. And some of our best performing stocks sectors this year, utilities, industrials, and what other one? Consumer staples and materials. Why would materials be doing okay this year? The US dollar is going down, so the price of commodities usually go up when the US dollar goes down. So maybe that could be helping some of the materials companies. Um, Consumer staples up almost 5.6%, probably because we have a lot of chaos this year. And whenever you have unknowns, a lot of at least the consumer staples pay dividends. And okay, let's look at our themes for this year. Investors will be reaching for stability amid chaos. Investors preparing for a slowdown in the economy and preparing for chaos. What would work best in that environment? Utilities, because utilities have two good things going for them right now. One, they pay a high dividend, and they're enjoying a lot of business from AI build out. So there's a lot of they're saying that you have to almost double the power grid for the demand for artificial intelligence servers. Um, okay, so healthcare hasn't done that great this year. I mean, this is almost the third or fourth year in a row that they've underperformed. So I was wrong about this healthcare, um, but we'll see if that turns around. Consumer staples is one of the best performing sectors. And the reason, I think one of the reasons why healthcare has underperformed this year is because there's threats for tariffs on pharmaceuticals and retribution from the current administration on health companies. So that could be really affecting the stock. And we have no control over that as an investor. We don't know what tariffs are going to be put on what products. Um, okay, that's all we can get from this screen. All right, so let's look at some of the top performers in the stock market, good and bad. Okay, so we have the theme here. Oh, we have T-Mobile for our theme for telecom as one of the safe sectors this year. We have Coca-Cola Enterprise. I don't know what that company, that maybe they're a bottling company for Coca-Cola. Mondelez, they're a staple company. They sell cookies and snacks. So um, they pay a dividend. So it's a safe stock. A lot of these are safe stocks. We have Constellation Energy. These are all these. A lot of these are stocks that I just talked about that are safe stocks. Constellation is utility, and Intuit, they must have just came out with earnings, and CrowdStrike. Okay, let's look at the ones doing the worst today. Ross Stores had a bad earnings report, so Ross and TJ Maxx kind of went down with it in sympathy. Um, just think about see work. Okay, TJ Maxx is a stock that went down 3% today, but they're doing pretty good so far. They buy a lot of unused inventory from other companies um, and they sell it at discounts at their store. So, and that model is doing pretty good. Let's see some more stocks. Okay, we have Apple that went down 3%. Apple was down primarily because um, the president capriciously said, well, we're going to either you stop manufacturing things in other countries and make them in America, or we'll put a tariff of 25% on your phones. That is a huge threat. It may not happen, um, but if it does happen, that would totally affect the profitability of Apple. So, um, because of those comments, people are going to pay less for United States stocks because they're not as reliable as they used to be because of the current economic, no, the current political environment. What other stocks are going down today? A lot of semiconductor stocks. Microchip, Global Foundries, Intel, OM Semiconductor. Okay, let's look at one, Axon. We'll have to review this next week. Axon is a company that sells a service for video cameras for cops. And they're also expanding into um, CVS to catch people that are shoplifting. So you have attendants wearing cameras in stores to catch shoplifters. Um, so what they do, Axon, is they sell the storage of the video, and they give away. I think they give away the cameras, but they charge for storing and retrieving the video. So companies like police departments, they um, they save their insurance by having proof of what they're doing in video format. So it's a necessity for a lot of police departments to have this service. And they're a little bit expensive right now, but they're growing a lot. So you see a lot of energy companies, utilities in the top holdings, top movers today. All right. All right. That was a good excursion. Let's look at, okay, we know the interest rates are going up. So let's try to make sense of um, why the sectors are going up and down. Okay, so we see the dollar going down. So that would make sense why gold miners are the top performers today. So we have gold miners ETF, um, energy ETF. Maybe it's because as the dollar goes down, commodity prices go up. Okay, so consumer staples. So you have a lot of high yielding sector that this high yielding sector is going up today. Utilities, consumer staples, and energy, real estate. Okay, so I'm surprised the real estate is going up because if the interest rates are going up, let's look at the interest rates. Oh, they're going down. Okay. They've been going up all this week. They're up 4% this week, 2 to 4%, but they went down a little bit recently. Um, okay. Well, that was a good exercise. We had risk off today. Basic risk off means everything that is high risk in the stock market that's been going up a lot has been giving back some. So let's go back to our talking points. Okay, let's look at Dan Now's picks from the beginning of the year. ADTN, not so great. Cisco is up 6%. We'll have to review that next week. Um, IJJ, this is the mid cap ETF. It's down 5%. KBWB, this is the bank ETF. It's down 1%. And cash was probably his best idea at the beginning of the year. Um, Guess we're looking at this article again, a little too enthusiastic. Wall Street warns against chasing stock rallies despite trade breakthroughs. The market might be a little bit too enthusiastic. The trade worries are behind us. Just think about right now, we still have, there's nothing that's been really resolved in anything trade. We have in 1 month, we have around July 4th, we're going to have all of these trade deals coming due. And if we might have another day where we have tariffs placed on every nation. So we have maybe one or two nations like the UK that have resolved their trade issues. So the trade framework is far from completed agreements. Okay. So we have this is one of the most important things. Erosion of trust and confidence in the US government and its policies. It has been severely bruised. In other words, people are not going to invest in the United States stocks or bonds like they used to. So there's less of a demand. So there's a good possibility we have higher yields on our bonds and lower prices on our stock market. All right, that's good to keep in mind. Okay, I already read this part. This is how tops form. Okay, so but basically what Josh Brown is saying is that, we had this correction here. We went down 20% in the stock market in April. We rallied up. We did not go back to that prior high, but we failed and we went down. So Josh Brown thinks we're in a bear market where we're going to have lower highs, lower lows. Um, we don't know, but that we're at a turning point right now where we're above the 200-day moving average. Let's hope we break out of this. And if we break out and start making higher highs, higher lows, then we're out of this situation. But time will tell. The reason why I say that is you can't get super overconfident that we're going to continue this uptrend when there is a downtrend in place right here. And it seems like we're following that pattern right now. Okay. Here's Josh's kind of understanding of what has happened since this Liberation Day correction. He says the best case scenario would be the S&P finds real support at the 200-day it's currently sitting on. So we're at the 200-day moving average right now. NVIDIA comes out with another blockbuster earnings report this week, and negotiation with foreign trade representatives go well. And this is like the best case scenario. The employment data surprised to the upside, and in the middle of the month, CPI report is tame, means inflation is not going up. If that happens, we can continue to rally and go and take out the February highs right here. And if anything of that doesn't go right, um, we might go down. So that's why we're at a decision point. So we'll see what happens. I picked out some charts that were pretty interesting to me. Look at the XLU. This is one of the sectors we picked at the beginning of the year as something that didn't do so well before, but now it's starting to do well. So it has two things going for it, the XLU. This is the utilities ETF. It has a high yield and it has artificial intelligence data center build out um, as something that helps it. So that, it's in its up. It's one of the only sectors in an uptrend, and it's not necessarily truly overbought right now either. It's halfway between overbought and oversold. So let's look at another one. This is uranium. This has been in a downtrend for over a year, but look, it just broke out of that downtrend. And we had a news story from Trump is actually helping nuclear plants. They had like a presidential um, note today that this week that supported nuclear activity in America. So that's going to really help this uranium ETF. So let's just watch this. I think we're in an uptrend here, and we've broken out of this multi-year down, at least 1 year downtrend. But we're overbought. Um, it seems like we're starting. Could be one of the better sectors this year. Let's look at Apple. Apple had a huge down day on Friday. It went down 3%. It was pretty bad news that Trump could target one company, one industry, the phone industry, and charge 25% tariffs on iPhones. So that obviously would make Apple about 25% less profitable, maybe 20% less profitable, which would really hurt its margins. So that's why it went down. And it seems, look at this. We're in a downtrend, making lower highs, lower lows. We haven't gotten back down to the point where we were at during Liberation Day. Um, we're halfway between overbought and oversold. So Apple has a couple different problems right now. Their PE ratio is around 28, and they're only growing around 9% or less per year, their earnings. So they're like three times, no, four times overvalued, three or four times overvalued, um, and they're not growing. So this stock could continue to fall until its peg ratio is one. Right now, the peg ratio is like three. So let's look at a couple good things about Apple is they come out with a new product like every 3 or 4 years. So they're almost due for a brand new product which could really catapult sales again. But there's always talk of new product, a new cycle for products. Right now, they said that they would have artificial intelligence in their products, and they put that in their current phones, but it is less than um, what they said it would be. So it's very disappointing what they've offered so far for artificial intelligence. They're very behind. So we'll see what happens with Apple. Let's look at AT&T. AT&T is in an uptrend. It pays like a 5% dividend, and it seems like um, it's right above its 200 20-day EMA, and it's one of the only stocks we're following that's continuing to be in an uptrend. Let's look at a great thing about AT&T is they don't have to worry about tariffs. They don't have to worry about anything political. All their business is in America. So most of the business is in America. So same thing with Verizon, a lot of the T-Mobile. And let's look at Netflix. It's hitting an all-time high recently. It's super overbought. The theme for this company is they're growing. They're they're growing their earnings between 15 and 20% a year. And so far, they don't have a whole lot of geopolitical risks. Like like Europe isn't taxing their services yet, or putting tariffs on their services. The one problem they might have is they have to pay some kind of tariff on foreign films that they show, but after that news hit, they haven't gone down. So let's look at Berkshire Hathaway. It's oversold. It's at the bottom part of their channel, and I think part of why they sold, they were going down in the stock is because Warren Buffett said he was not going to run the company anymore after the end of the year. So there's a loss of confidence. So maybe some of the premium people gave Berkshire Hathaway because Warren Buffett was running it has gone away. I don't know, but it's still in an uptrend and it's oversold. Let's look at NVIDIA. Okay, their earnings come out this Wednesday. You can see we're in an obvious trading range. We're at the top of the trading range now. Um, this is going back at least a year. The low in the trading range is 100. The max is 130. So right now we have earnings come out. Even if they say they're going to have great earnings or great, if they have better earnings than expected, they have better projections, it's very, very possible that they could sell off maybe 7 or 10%, just because of the buy on the rumor, sell on the news. People expect right now, the rumor is people expect them to have good earnings. But if they maybe miss or they have some kind of restriction for selling to China that caused them to lose money. Something, a hiccup, their stock will go down 10% and maybe go down to 100. And that will be the perfect time to buy it because look how many times it hit that 100 and the stock bounced back. So be ready for that if it happens this week. All right, so Eli Lilly, let's look at this stock. You can see this is one of the stocks in the top holdings of some of our favorite mutual funds. You can see that all the drug stocks currently are out of favor. Um, there's threats on the drug companies for being taxed. There's threats of not covering drugs in Medicare. Um, there's a lot of political um, targets. And it seems like Eli Lilly has had a lot of good news recently. Their drug is far superior than any other weight loss drugs on the market. And they've ramped up production, so they have a lot of things going for them. I think one of the reasons why they're down recently from this drop right here is they released their earnings and their earnings weren't as good as expected. So they are basically at the bottom end of their range. They're super oversold right now. So we don't know how much longer it's going to take for them to get back into favor. So it's just a waiting game right now. Let's look at T-Mobile, another example of a utility that it pays a large dividend. No, they don't pay a large, they pay a small dividend, but they're a utility, they're US based, so they don't have to deal with anything tariffs. And they're beating their competition. They're the largest telecom company in America now. So, and they're right at their 200-day moving average. So that's pretty good. And they're in an uptrend. So this is one of three or four stocks that are still in an uptrend that we're following. Let's look at gold. Um, we mentioned the US dollar has been going down, and we have central banks that are buying gold, and we see it's near the bottom of its trading range. It's kind of halfway between overbought and oversold right now. Um, it's in an uptrend. It's one of the only things going up this year. We have 30% return so far in gold. So I just have to remember to tell you that Warren Buffett wouldn't buy gold because he doesn't see it yielding anything, and it's very speculative. All right, so healthcare. This is almost a lot of drug stocks look like this. Their charts look like this. Look how this has underperformed. It's going. This sector has underperformed all other sectors going back 3 years now. So we're definitely not in an uptrend. So if you buy a stock in this industry, you have to be willing to, you have to know that we're not, you might be dollar costing down if you buy some right now. All right. So let's look at the top holdings of Bill Ackman. They just came out recently. So he actually recently added Uber Technologies as one of his top holdings. Um, and you can see they're up 45% so far this year. So he got that one right. So he bought it before it went up 45%, I'm sure. So look at this. Hertz is up 92% this year. And what are the ones that are new? He got rid of Nike. We've been following Nike for a while, and basically Nike is super overvalued compared to how much they're growing. So they're growing. Their PE ratio is really big, and they're growing on maybe 5 or 10%. So I'm glad I didn't follow Bill Ackman into Nike. But we're going to look at Uber because that's his top holding right now. So he has Uber Technologies as his top holding. Uber has they basically offer the ride sharing, and they offer it through the app, and they also have Uber Eats, which is a good portion of what the money they make. So they deliver food for restaurants and for other, they also deliver packages. So let's look at their earnings projections. Um, Last year to this year, they grew 70%. This year, they're expected to grow 35% from this year to next year, and then 22% from the year 26 to 27. So let's look at their PE ratio is 32. So if their PE ratio is 32, they're about fairly valued if they're growing 35. So they're currently at a fair value, it seems. Let's look at let's look at their chart. They've been basically going sideways for like over a year. The reason is they weren't profitable like up until like right here. And then they turned to profit. So now they're in the process of becoming a real company. I mean, actually, that makes money. Okay, let's look at their chart. Okay, their chart is, you can see that they're above all of their moving averages. Green is the 200, this is the 150, and this is the 20-day EMA. So, so it looks pretty positive. They're in an uptrend. They're overbought right now. So it seems like whenever the market sells off next, yeah, I want to look at it when it's at the bottom end of this upward channel. Okay, you can see that they're a pretty big company. They're a $200 billion company. Their forward PE is 32. Their profit margin is double what we're looking for at 27. Return on equity is like 4 or 5 times more than we're looking for. So that's really good. They have more, they have 6 billion in debt out of 183 billion. That's not that bad. That's a negligible. And they make a lot of money. They have 5 billion in levered free cash flow. So all the numbers look really good for Uber. They're just a little bit overvalued. Let's see what CFRA says. They said our buy rating reflects Uber's strong execution in driving growth while expanding margins. Network effects from 170 million active users create a competitive advantages through cross-selling between segments. The strategy partnerships with Waymo, Pony.ai, WeRide position Uber well for the future while limiting capital intensity. So basically, they're using, whenever you order an Uber, you can actually use Waymo as an autonomous way to take your ride. So they might be a beneficiary from auto robo taxis. A lot of people left them for dead because they saw the robo taxi coming out. Some issues with the robo taxi. Waymo has their act together. It seems like there's a lot of crashes with Tesla's robo taxi. So maybe it's going to be at least a year before Tesla has as many cars on the road as Waymo. So it looks like they have, at least for the next year or two, they have something, they have an aggregating platform, meaning they are the they are the app that everyone goes to. So they have 170 million users now, and they can actually use Waymo and other robo taxis for their services, and they make more profit that way. So yeah, the one issue is if Tesla is successful with this robo taxi um, deployment and they offer a better price than Uber, perhaps they could lose a lot of their market. So that's part of buying Uber. Let's look at what CFRA says. They say their fair value is 94. So they're undervalued by 3%. So they're about fairly valued according to CFRA. Let's look at their numbers. Their free cash flow, you can see that why they were down for such a long time. They weren't profitable until 2022. And right around 2023, they started making a profit. And look, they're doubling their profit every year. And you can see that their revenue is is going up every year in like maybe 10, 15%. That's what we like to see in a good growth stock. And let's look at what Morningstar says. The last time they made this report was December, so we can't take too much from this. They said the fair value is 78. We can't really get a whole lot from this because they haven't updated um, their information yet. You see, so they see Uber as a better platform than Lyft, and okay, well, this is an older report, so I won't even review this. Okay, let's look at some more of the top holdings of the mutual funds. Fidelity Magellan, they have NVIDIA, Microsoft, Amazon, Meta, Broadcom, Alphabet, Eli Lilly, Visa, JP Morgan, and MasterCard. If we ever see these stocks sell off in a large way, we have to consider buying some of those for our long-term holdings because if Magellan and Contrafund have, own these stocks and they've held them for 10 years, it's a good idea that these are quality stocks. They're just on sale. All right. So, right. Let's look at the stock screen from this week. We can see Uber is one of our stocks that has been on the screen for quite a while. It looks like it's a little expensive. It says its PEG ratio is 1.6, so it's pretty, but um, we can wait for it to go on sale, and we'll just keep watching to see if it goes on sale. Let's look at NVIDIA as a stock because it's going to be reporting the earnings this Wednesday. It's gone up a lot, 30% in the last month. So let's look at what their earnings really are, projections. So from this year to next year, NVIDIA is going to grow 48%. That is pretty big. So if their PE ratio is 30, they're growing at 48. It seems like they're 40% undervalued. Um, but from 26 to 27, they're scheduled to grow at 28%. So in that sense, they'd be around fair value right now because they'd be growing. If their PE ratio is 30 and they're growing at 30, then they're fairly valued. So we'll see um, how this changes over time, but we got to keep track of it. According to Yahoo Finance, they're overvalued by like 80%. So almost double what they're truly worth. I don't know how they get that, but their profit margin is off the charts. That's 5 times what we're looking for. Return on equity is 10 times what we're looking for. And they have more cash than debt, and they have a lot of free cash flow, 44 billion in free cash flow. So all these numbers are off the charts for quality company. But you can see that they're in this trading range going back at least a year. So we're at the top of that trading range now. So if um, we have expectations that the stock will have good earnings and it goes up to the top of this range, this is like Lucy pulling the football from Charlie Brown. As soon as even whatever they say on that day, if it slightly isn't up to expectations, the stock will be back down here. So buying a rumor, maybe selling the news. We don't know. But we're currently above all the moving averages, and the moving averages are positive, and in that sense, it's a pretty good sign. But we're stuck in this trading range. So if we ever get back down to this 100 level, that'll be time to really buy that stock. So we'll see. Okay. Um, okay, so let's look at the CFRA's idea on NVIDIA. They say it's overvalued by 1.55%. So it's about fairly valued where it's at right now. Um, what they say is our buy reflects NVIDIA's expanding total addressable market, edge device penetration and software opportunities. Recent developments strengthen our conviction. Trump administration's more lenient China approach, AI leverage in trade deals, Saudi Arabia's deal recently, and scrapped AI diffusion rule. The robust product roadmap supports growth visibility. NVIDIA Dynamo, which is mentioned this week, and partnerships demonstrate ecosystem expansion. Platform sales versus just GPUs enable capturing more data center capex. So the good thing about NVIDIA is all the earnings for the big tech stocks have already been out. Every single tech stock that is big said they're spending big on NVIDIA chips. So we've already been told that their sales are going to be off the charts. So even though, yeah, so we expect a good report, but even if they give a good report, the stock could sell off. So you got to be ready for this stock to stay in this trading range and go down 7% more, or something like that, or go up 7%. We don't know. So it seems like a good quality company. Let's look at the numbers for NVIDIA. Free cash flow. Look how it's going up in a straight line. We have revenue doubling every year for the past couple of years. That is amazing. Their cash has gone up every year. And look at this return on equity. This is one of the most important things. This is their margins. They have 17, 91.5, 119. So they're getting more and more efficient as they make these products. And um, let's look at what Morningstar says. They said their fair value is 130. They said this, oh man, um, they said this in April, beginning of April. So 8th of April. So this is a month ago. So they're right at their fair value. So um, they think they're trading at a fair value right now. Um, okay, so I'm going to review this Zwig breadth thrust. Okay, this guy, he basically had this calculation where if you have a big drop in stocks and then you have an uptrend again, let's look at the S&P 500. Okay, you have this big drop and then you have a lot of momentum, coming back from that. Um, they're basically saying that calculation is 100%, has worked 100% of the times for the past 30 years or 100 years. But that doesn't mean that we don't drop back down to here before we go back up before the end of the year. So we have a lot of bad news recently. So we very well could, um, that breadth thrust might not work if we have a lot of uncertainty. We have a lot of geopolitical issues. If we have foreign central banks and companies selling America's stocks due to issues with bonds that are going up. So we don't know if this is going to work now. So don't put all your eggs in one basket and trust in that. Um, I don't know. I just wanted to say that before we're done. I think that was all I had to say. I hope you enjoyed the talk and have a good investing week.